Hey there, I'm Money Mindset, and listen up because I'm about to drop some serious truth bombs about investing. Did you know that 75% of new investors lose money because of simple mistakes? That's right, folks, 75%. Most of these traps are totally avoidable, yet they catch even seasoned investors off guard. You see that stock chart crashing down? Those are the dreams of uninformed investors getting wiped out. Don't let 2025 be the year your investments derail. In this video, I'm going to break down the 3 biggest investing traps that could absolutely crush your portfolio if you're not careful. We're talking emotional decision-making, lack of diversification, and blindly following trends. Stick with me, and I'll give you the knowledge you need to sidestep these pitfalls and come out on top. All right, let's talk about emotions, folks. Emotions are a natural part of being human, and they can influence many aspects of our lives. But when it comes to investing, letting your emotions take the wheel can lead to disastrous outcomes. We've all got them, but when it comes to investing, they can be your worst enemy. Emotions like fear and greed can cloud your judgment and lead you to make decisions that aren't in your best financial interest. See, fear and greed, they're like 2 sides of the same bad coin. They can push you to make impulsive decisions that you might regret later. Fear makes you sell low, panic selling when the market takes a dip. It's a natural reaction to want to cut your losses, but it's often the worst thing you can do. You see those numbers going down and you think the world's ending. But hold your horses. The market has its ups and downs, and a dip doesn't mean it's time to jump ship. What happens when you sell low? You lock in your losses. Instead of giving your investments time to recover, you cement your financial setback. You lock in your losses. You're basically handing your hard-earned money over to the savviest investors who are buying low. You're basically handing your hard-earned money over to the savviest investors who are buying low. These experienced investors know that market dips are often opportunities to buy valuable stocks at a discount. Don't be that guy. Don't let fear drive your investment strategy. Now, on the flip side, we've got greed. Greed can be just as dangerous as fear. Greed makes you buy high, chasing after the hottest stock everyone's talking about. It's easy to get caught up in the excitement and think you're about to strike it rich. You see a stock skyrocketing and you think you're going to miss out on the next Amazon. But remember, what goes up must come down. So you jump in at the peak, just as the bubble's about to burst. Remember GameStop? It was a wild ride, but many who bought at the peak ended up with significant losses. Remember all those folks who bought in at the top thinking they were going to get rich quick? Where are they now? Many are left holding the bag with investments worth far less than they paid. Holding the bag, that's where they let greed cloud their judgment and paid the price. Listen, I get it. Investing can be an emotional roller coaster. Investing can be an emotional roller coaster. The highs and lows can be thrilling and terrifying at the same time, but you gotta learn to control those impulses. Take a step back, breathe, and think before you act. Don't let fear or greed make your decisions for you. Instead, rely on a well-thought-out strategy and stick to it. Instead of panicking when the market dips, take a deep breath, do your research, and look for buying opportunities. Often, the best investments are made when others are fearful. And when everyone's chasing the next hot stock, take a step back and ask yourself, is this really a solid investment, or am I just getting caught up in the hype? It's crucial to differentiate between a good investment and a fleeting trend. Remember, investing is a marathon, not a sprint. It's about long-term growth and stability, not quick wins. It's about making smart, calculated decisions based on facts, not feelings. Emotions can be misleading, but data and research provide a solid foundation for your investment choices. So, keep your head cool, your emotions in check, and you'll be well on your way to building a portfolio that can weather any storm. Stay disciplined, stay informed, and stay the course. Let's talk about diversification, folks, because this is where a lot of investors, even the seasoned ones, trip up. Diversification is a fundamental principle in investing, yet it's often overlooked or misunderstood. It's not just about spreading your money around. It's about strategically allocating your investments to minimize risk and maximize potential returns. You see, putting all your eggs in one basket, that's just asking for trouble. It's a risky move that can lead to significant losses if things don't go as planned. Imagine this. You've got your whole portfolio riding on one stock, one sector, even one country. It might seem like a good idea when things are going well, but it's a precarious position to be in. Everything's going great, your investment's soaring, you're feeling like a financial genius. The returns are high and it seems like nothing can go wrong. But then, bam, something unexpected happens. The market is unpredictable. and unforeseen events can turn your fortunes around in an instant. Maybe there's a scandal in that sector, maybe that country's economy takes a nosedive, or maybe that one company you bet the farm on makes a bad call. These are all scenarios that can drastically affect your investment. Suddenly, your golden goose is laying rotten eggs, and your portfolio is taking a serious hit. The once promising investment is now a source of stress and financial strain. That's why diversification is key, folks. It's about spreading your investments across different assets to reduce risk. You gotta spread your risk around. By investing in a variety of assets, you can protect yourself from the volatility of any single investment. Don't put all your faith in one stock, no matter how promising it seems. Even the most stable companies can face unexpected challenges. Think of it like this: you wouldn't build a house on just one pillar, would you? No way. A single pillar can't support the entire structure. You'd want multiple strong pillars to support the weight and keep your house standing strong. The same principle applies to your investment portfolio. The same goes for your portfolio. Diversification helps create a balanced and resilient investment strategy. You need multiple, strong investments across different sectors, asset classes, and even geographies. This way, you're not overly exposed to the risks of any single area. This way, if one area takes a hit, the others can help cushion the blow and keep your overall portfolio afloat. Diversification acts as a buffer against market volatility. Now, I know what you're thinking. Diversification sounds complicated, right? It can seem overwhelming, especially if you're new to investing. But it doesn't have to be. There are straightforward strategies you can use to diversify your investments without getting bogged down in complexity. There are plenty of simple ways to diversify, even if you're just starting out. You don't need to be an expert to create a diversified portfolio. You can invest in index funds or ETFs that track the broader market, which automatically gives you exposure to a wide range of assets. Or you can work with a financial advisor to create a personalized portfolio that meets your specific needs and risk tolerance. A professional can help you navigate the complexities of diversification. The bottom line is this: diversification is your best defense against the unexpected. It's a proactive approach to managing risk. It's about protecting your hard-earned money and building a portfolio that can weather any storm. By diversifying, you create a safety net that helps ensure your financial stability, no matter what the market throws your way. All right, let's talk about trends, because in the world of investing, trends are like tourists. They come and go. They can be exciting and full of promise, but they can also be fleeting and unpredictable. Just because something's hot today doesn't mean it'll be hot tomorrow. Remember the dot-com bubble? It was a time when the internet was new and full of potential, and everyone wanted a piece of the action. Everyone and their grandmother was pouring money into any company with a .com at the end of its name. It didn't matter if the company had a solid business plan or not. The hype was enough to drive investment. They were chasing after the next Amazon, the next Google. But guess what? Most of those companies didn't have what it took to succeed in the long run. Most of those companies went bust, and a lot of folks lost their shirts. The bubble burst and the market corrected itself, leaving many investors with significant losses. Then there was the cryptocurrency craze. Bitcoin, Ethereum, Dogecoin, and a slew of other digital currencies took the world by storm. You name it, everyone was buying it up, thinking they were going to get rich quick. The allure of making a fortune overnight was too tempting to resist. But then the bubble burst, and the value of these cryptocurrencies plummeted, leaving a lot of investors holding the bag. The market's volatility became painfully clear. The same thing happens with meme stocks, folks. Remember GameStop? It was a wild ride that captured the world's attention. A bunch of folks on social media decided to pump up the price of a struggling video game retailer, sending Wall Street into a frenzy. But guess what? The excitement was short-lived. The hype eventually died down, the stock crashed back to earth, and a lot of those amateur investors learned a very expensive lesson. The reality of market dynamics set in. Here's the thing about trends. They're often driven by speculation, not fundamentals. People get swept up in the excitement without considering the underlying value. People get caught up in the hype. They see others making money, and they don't want to miss out. It's a classic case of FOMO, fear of missing out. They see others making money and they think, why not me? But this kind of thinking can lead to rash decisions, and they don't want to miss out. They jump in without doing their homework, without understanding the risks. But they're not thinking about the long-term viability of the investment. They're not considering whether the company has a sustainable business model. They're not looking at the company's financials, its earnings, its debt, or its growth potential. These are critical factors that determine the true value of an investment. They're not considering the market conditions, the economic environment, or the competitive landscape. All these elements play a crucial role in the success or failure of an investment. They're just following the crowd. And as we all know, following the crowd can lead you straight off a cliff. It's a dangerous game to play. And as we all know, following the crowd can lead you straight off a cliff. It's a risky strategy that often ends in disaster. So, what's the takeaway here? Don't blindly follow trends. Be a smart investor. Take the time to do your own research. Just because everyone's talking about a particular stock or asset class doesn't mean it's a good investment for you. Do your own research, understand the risks involved, and make informed decisions. And make sure the investment aligns with your overall financial goals. It's important to have a clear strategy and stick to it. Remember, investing is not a get-rich-quick scheme. It's a journey that requires patience, discipline, and a long-term perspective. It's about making smart, informed decisions that will help you build wealth over the long term. Stay focused, stay informed, and don't let the hype distract you from your financial goals. So there you have it, folks, the 3 biggest investing traps to avoid in 2025. Remember, investing doesn't have to be a gamble. By understanding these pitfalls and taking a disciplined approach, you can make your money work for you and achieve your financial dreams. Have you fallen into any of these traps before? Share your experience in the comments. I'd love to hear how you've grown as an investor. And don't forget to subscribe for my next video, where I'll reveal 3 untapped investment strategies for 2025. See you there.